Moving forward to one of the most important chapter on scoring chapter in our management accounting. This chapter decides your CMA career. Literally, this single chapter decides your entire CMA career. What is it? Marginal costing. It is like a మిమ్మల్ని వెంటాడే ఎమోషన్. మార్జినల్ కాస్టింగ్ వచ్చింది ఫౌండేషన్ నుంచి ఫైనల్ వరకు మిమ్మల్ని వెంటాడే ఎమోషన్ అనమాట. వాట్ ఈస్ మార్జినల్ కాస్ట్? ఫ్రమ్ పాస్ట్ 3 years, from +2, foundation, group 1, intercasting, we are learning this marginal cost. What is marginal cost? లాస్ట్ బెంచ్ స్పెట్స్ మీరు చెప్పండి. వాట్ ఈస్ మార్జినల్ కాస్ట్? కూర్చో. వాట్ ఈస్ మార్జినల్ కాస్ట్? వాట్ డూ యూ నో అబౌట్ మార్జినల్ కాస్ట్? Fixed expenses got eliminated. So in simple words, marginal cost is nothing but additional cost, extra cost. For what? For producing an extra unit. Additional cost is nothing, marginal cost is nothing but additional cost for producing the additional unit. For example, till now I produced 200 units. How many units I produced? 200 units with a cost of 10 rupees per unit. I produced how many units? 200 units with a cost of how much? 10 rupees per unit. It will cost us total 2000. Now I am incurring for producing 201 unit. For producing entire 2201 units, it cost me 2005 rupees. Now what is my marginal cost? My marginal cost is difference between these two. How much it is? 5 rupees. For producing one additional unit, I am incurring how much? Extra 5 rupees. That 5 rupees is my marginal cost. It is also called as variable cost. Always variable cost is marginal cost only. What is marginal cost? The cost incurred to produce one extra or one additional unit is marginal cost. Now, as per marginal costing, total cost is divided into two types. As per marginal costing, total cost is divided into two types. One is variable cost, another one is fixed cost. One is variable cost, another one is fixed cost. As per marginal costing, variable cost is included in product cost. As per marginal costing, the variable cost portion is included in the product cost, and fixed cost is treated as period cost. That means whatever you are incurring as a variable cost, it is directly related to the product manufacturing cost. Without variable cost, it is not possible to produce a product. But when it comes to fixed cost, it is treated as period cost. You are incurring for a period, for 1 month, for 1 year, or for 1 week. You are not directly incurring for producing the product. Even if you are not producing the product, you have to pay the fixed cost. Like I took one space for rent, where I am using it for producing my goods. Now I am not producing any goods due to some raw material unavailability or labor strike or due to my personal reasons. Now I need to pay rent. Even I am not producing any product, I have to pay the rent. That's why this fixed cost is not treated as a product cost. It is treated as a period cost, and variable cost is included in the product cost. It is treated as a product cost only. Not only variable cost, whatever additional cost you are incurring, whatever additional cost we are incurring, we always take it into consideration. Whatever committed cost, Committed cost is nothing but fixed cost. Whatever committed cost we have, we ignore at calculating the marginal cost. In marginal costing, variable cost is given more importance than fixed cost and even not considered in valuation of stock. Under marginal costing, while you are calculating or valuing the stock, you ignore this fixed cost. As per marginal costing, stock is valued at only variable cost. As per absorption costing, stock is valued at total cost. As per marginal costing, the stock is valued at variable cost only. As per absorption costing, opening stock as well as closing stock valued at total cost. Now, where we apply this marginal costing techniques. This marginal costing techniques is applied in one-time decisions. One-time decisions and short-term decisions. These marginal costing techniques are applied in one-time and short-term decisions like acceptance of special orders, make or buy decisions, pricing of perishable product, CVP analysis. What is CVP analysis? Hey, you guys already done with group 1 costing. You have to know something about CVP analysis. What is CVP analysis? Group 1 కాస్టింగ్ లో రాలేదా సివిపి అనాలిసిస్? మార్జినల్ కాస్టింగ్ అవ్వలేదా? మీకు ఎగ్జామ్ రాశారుగా కాస్టింగ్ ఎగ్జామ్. మార్జినల్ కాస్టింగ్ చదవకనే రాశారా? సివిపి అనాలిసిస్ ఈజ్ నథింగ్ బట్ కాస్ట్ వాల్యూమ్ ప్రాఫిట్ అనాలిసిస్. వాట్ ఈస్ సివిపి అనాలిసిస్? కాస్ట్ వాల్యూమ్ ప్రాఫిట్ అనాలిసిస్. ఇట్ ఈస్ లైక్ cost, volume, profit analysis. Now marginal costing techniques are used in one-time decisions and that too short-term decisions. That means the period is less than 1 year. Now what about long-term and continuous decision makings? Which technique we will use? ABC is not a technique. It is like a method of costing to analyze the correct cost. ABC costing అనేది in costing, if you divide the costing into 3 parts, one is elements of cost, another one is methods of cost, and finally techniques of cost. Elements of cost, methods of costing, techniques of costing. What is this elements of cost? What is the meaning? Elements of cost is nothing but where we are incurring the expenses. In what form we are incurring the expenses? Is it in direct material form, or is it in direct labor form, or it is in indirect expenses form, or like overheads? This is called elements, where we are incurring our expenses, where we are incurring our cost, in what form. Next, coming into methods, we already incurred the cost. Now it's duty to calculate the cost or find the cost. So these methods are help us to calculate the cost. These methods are help us to find the cost. It is nothing but methods of costing. Next, finally, techniques of costing. We already calculated the cost. We have already some reports regarding the cost. Now it's duty to take decisions. These techniques help us to take decisions in the organization. Take decisions. These techniques help management to take proper decisions within the organization. This is all about costing. Next, so marginal costing techniques are applied in one-time decision making and the two short-term decision making. What about long-term decision making and continuous decision making? Do you guys are completed with financial management? No. There is one chapter or one topic called capital budgeting. In financial management, you will get one chapter that is capital budgeting, where we use the discounted and non-discounted techniques, as well as where we use time value of money. Whenever our decision is more than 1 year, decision period is more than 1 year, we use capital budgeting technique, that too using time value of money. Next, the statement under marginal costing. This is a statement under marginal costing. First, sales. If you minus variable cost from sales, you will get contribution. After getting the contribution, if you minus fixed cost, you will get profit. Contribution consists of two elements. One is fixed cost, another one is profit. Next, what we are going to learn in this chapter. First one, basics of CVP analysis. Next, BEP analysis, nothing but break even point analysis, indifference point analysis, shutdown point, marginal costing versus absorption costing, like nothing but how to calculate cost under marginal costing technique and absorption costing technique, and what is the differences, where you get mostly differences between marginal costing and absorption costing. Next, key factor or limiting factor analysis. It is also called as optimum utilization of resources. Make or buy decisions, which includes make or subcontracting as well. Acceptance and rejection of order. Price fixing, fixation of prices using marginal costing technique. Relevant costing. So in your institute material, they didn't given any information, any info regarding relevant costing, but in practical questions they given some questions. They didn't given anything about relevant costing in theory part, but when it comes to problematics, I think it's 27th question, they given relevant costing question. So that means we have to learn relevant costing as well. One of the biggest chapter in entire management accounting is marginal costing only. If you learn the marginal costing fully, it is very easy to solve problems from transfer pricing. Transfer pricing is indirectly linked with marginal costing. Now, coming into first topic, that is basics of CVP analysis. What is CVP analysis? Cost, volume, profit analysis. This CVP analysis shows relationship between three important elements. The CVP analysis shows the relationship between three important elements. One is selling price, another one is cost, and finally volume. It helps us to understand that how profit is get affected if any one of the above factors change. CVP analysis main aim is to understand how profit is affecting when any one of the above factors like selling price, like cost or volume is changed. Now, while doing the problems from CVP analysis, you need to take some assumptions. While doing the problems from CVP analysis, you need to take some assumptions. Unless otherwise stated, variable cost per unit is constant. Unless otherwise stated, if nothing said in the question, that means variable cost per unit is constant. Fixed cost in total remains same. fixed cost in total, not per unit. Fixed cost in total is same. Now in any costing problem, if you want to talk something about variable cost, always talk in units. You have to mention variable cost always in per unit basis. Whenever you are talking something about fixed cost, if you want to mention about fixed cost, always mention in total. Why? What is the reason? That means whenever you have to say something about something, always say in constant terms. Variable cost in total always change. It is determined by number of units. Fixed cost per unit is also always changes. When output increases, fixed cost per unit decreases. When output decreases, fixed cost per unit is increases. When it comes to variable cost per unit, it is always constant. For example, for making this bottle, first unit of this bottle, I incurred a variable cost of 100 rupees. For making second bottle, 100. For making third bottle, 100. If you make 1000 bottles also, for making thousandth bottle also, the variable cost is 100 only. Now I took this room. I took this room for a rent of 10,000. Now I have to share this entire 10,000 between the class students. Now my class students is 10 members. Each student will get a share of 1000. My class students increase it to 20. Each student will get a share of 500. My class students increase it to 40. Each student will get a share of 250. Now when output is increasing, fixed cost per unit is decreasing. When output is decreasing, fixed cost per unit is increasing. So fixed cost per unit is variable. Fixed cost per unit is variable and variable cost per unit is constant. That's why whenever you are talking about variable cost, always mention it in per unit basis. When you are talking about fixed cost, always mention it in total basis. And another assumption is company produces only single product. Company is producing single product only, unless otherwise stated. If question is saying company is producing two products, then take it as two products. If nothing said in the question, company is producing only single product. Next, all costs are segregated into fixed and variable cost. It is possible to, we are able to segregate all the cost, whatever cost we are having, into fixed and variable. These are the assumptions under CVP analysis while doing the problem. Next, any change in variable cost should be applied on per unit basis. If you got any change in the question, it must be applied on not total basis. Any change happen to variable cost, always you should apply on per unit basis. Why? It is constant. Any change in fixed cost should be applied on in total. If they mention something like special fixed cost, additional fixed cost, then you have to apply it on per unit basis. No, in total. You have to add total amount to the total fixed cost. If they said variable cost is increased by 20,000, sometimes they said like this, variable cost is increased by 20,000, you must divide it with the number of units, then add to the per unit. You will get the per unit increase, then add to the total variable cost per unit. Now what is CVP analysis? It shows the relationship between selling price, cost and volume. It tells us how profit is affecting with any change in the above three factors like selling price, volume and cost. Now here selling price is 20, quantity of units is 200, cost is 15. Now what is the profit? Total revenue is 4,000, cost is 3,000, we got a profit of 1,000. Case 2, here selling price is how much? 18. Now selling price is changed. there is no change in the quantity and cost. Now our sales is 3600, cost is 3000, profit is affected by how much? 400 rupees. Now profit is 600 only. If selling price is changed, profit is also changing. Case 2, selling price, there is no change in selling price, that is 20 rupees. Quantity is also same, 200, but cost is decreased from 15 to 14. Now what is the total sales? We have 4000 and cost is 2800. Now our profit is increased by 200. If cost is decreasing, profit will increase. If selling price increases, profit will also increase. If selling price decreases, profit will also decrease. There is direct relationship between selling price and profit. If cost increases, profit will decrease. If cost decreases, profit will increase. There is a inverse relationship between cost and profit. Coming into case 3, quantity. Here selling price is same, quantity is increased from 200 to 300, cost is also same. Now what is our total sales? 6000, cost is 4500 and profit is affected, it is increased from 1000 to 1500. So there is a direct relationship between quantity and profit. If quantity increases, profit will also increase. If quantity decreases, profit will also decrease. Important formulas under which costing? Marginal costing. First one, we are going to learn about contribution. Next, PV ratio. Next, break even point, margin of safety, indifference point, shutdown point analysis. Without any delay, we will move forward. That is nothing but contribution. What is it? Contribution. How you will get contribution? If you minus variable cost, if you deduct variable cost from sales, you will get contribution. It is the surplus earned on sales of a product. It is a surplus earned on a sale of product over its variable cost. Any amount over variable cost is known as contribution. Contribution consists of two elements. One is fixed cost, another one is profit. Now contribution first utilized to recover the fixed cost. The any amount left is profit. The total contribution is first utilized to pay fixed cost and remaining thereafter is profit. No need to write. I will share it in your Telegram group or in this WhatsApp group. Do you have WhatsApp group or Telegram group? Telegram group only. Okay. I will share it in Telegram group. Next, formulas. Selling price per unit minus variable cost per unit. If you deduct variable cost per unit from selling price per unit, you will get contribution per unit. Selling price per unit minus variable cost per unit, you will get contribution per unit. Or total sales minus total variable cost. Total sales minus total variable cost, you will get contribution. Fixed cost plus profit also, you will get contribution. Total fixed cost plus total profit, you will get contribution. Another formulas are also there. Quantity sold or sales units into contribution per unit, you will get contribution. Sales units, sold sales units or volume of sales into contribution per unit, you will get contribution. Another one is sales into PV ratio. Sales into PV ratio, also you will get contribution. These are the available formulas we have for calculating the contribution. So based on the situation, based on the nature of the question, you use different formulas for calculating the contribution. Next, profit volume ratio. Profit volume ratio, nothing but PV ratio. It is the ratio of contribution to sales. It is the ratio of contribution to sales. What is the contribution ratio in total sales? So contribution divided by sales into 100, you will get the PV ratio. Contribution divided by sales into 100, you will get the PV ratio. Contribution per unit divided by selling price per unit, you will get PV ratio into 100. You will get PV ratio in percent. Next, total contribution divided by total sales into 100, you will get PV ratio in percentages. Next, 1 minus variable cost percentage. 1 minus variable cost percentage, also you will get the contribution percentage or PV ratio. So if total sales consist of variable cost plus contribution, if you minus variable cost portion, you will get the contribution portion only, na? That means 1 minus variable cost portion, you will get the contribution portion or nothing but PV ratio. Example number 1. Read the question. Hope you guys are understanding what I am saying. Are you finding any difficulty in till now? No, no. Now, selling price is 10 rupees. Variable cost is 6 rupees. Fixed cost is 500. Volume is 200. Volume means units. Volume means output or units. You are required to calculate contribution, PV ratio and profit. Now, first, contribution is equals to sales minus variable cost. Now, what is the sales we have? Total sales. Here he asked contribution, not contribution per unit. If he asked contribution per unit, 10 minus 6, that is 4 only. He asked us to calculate contribution, that means total contribution. Here blind assumption. Now 200 into 10, this is total sales, minus 200 into 6, that comes to 800. Our contribution is 800. Next, he asked us to calculate PV ratio. What is the formula? Available formulas for calculating the PV ratio. One is contribution per unit divided by selling price per unit, total contribution divided by total sales. Here we already calculated the total sales as well as total contribution. Now we are using the formula for PV ratio. Sales, that is contribution is 800, total contribution divided by total sales, that comes to how much? 800 divided by 2000 into 100, that is 40%. Your contribution portion is how much? 40%. Next, he asked us to calculate profit. How you will get profit? How many formulas we have for calculating the profit? Sales into PV ratio minus fixed cost, you will get the profit. So sales into PV ratio, that is nothing but contribution. Contribution minus fixed cost, you will get profit. Profit is equals to fixed cost minus contribution minus fixed cost, that comes to how much? 800 minus 500, our profit is 300. That is our profit. Next. If PV ratio is 60% and the marginal cost of the product is 20, marginal cost is nothing but, what is marginal cost? Variable cost. Your blind assumption, marginal cost is nothing but variable cost. What will be the selling price? Tell me. $50. Are you sure? Here if you see, selling price is equals to contribution plus variable cost. Am I correct? Now take the selling price as 100%. Now PV ratio is nothing but contribution portion. PV ratio is nothing but contribution portion. That is nothing but 60% plus. What left? Variable cost only. Now variable cost portion is how much? 40%. Now this marginal cost is nothing but variable cost. Now marginal cost is equals to, marginal cost is how much? 20 rupees is equals to how much? 40%. Am I correct? This 20 rupees is equals to 40%. Now what is the value of 100%? 40 divided by 20 into 100. How much you got? Here PV ratio is 60%. That is nothing but it is equals to contribution portion. It is equals to contribution portion. Now selling price is nothing but contribution plus variable cost. Now variable cost is how much? 20 rupees. That is equals to how much? 40%. If variable cost is equals to 40%, nothing but 20 rupees is equals to 40%, then what is the value of 100%? Nothing but cross multiplication only. It is mathematics. I am the student who failed in mathematics. I don't think that I am very much genius than you in mathematics. You guys are past students in mathematics, I think so. మీరు మ్యాథమెటిక్స్ అందరూ పాస్ అయ్యారు కదా, నేను ఫెయిల్ అయ్యా. సో మీకు మ్యాథ్స్ బాగొచ్చా, నాకు మ్యాథ్స్ బాగొచ్చా? మీకు బాగొచ్చు. Any doubts regarding this question? I hope you understand this. Next, coming into next one of the most important topic. What is it? Break even point. What is break even point? It is level of sales or nothing but level of output at which level of sales or level of output or level of volume or level of activity, anything at which your contribution is equals to your total fixed cost. At break even point, whatever contribution you have is equals to your fixed cost. That means your total contribution is utilizing for paying fixed cost only. You are lefting with zero as a profit. That means at break even level your profit is zero. At break even point you won't get any profit. That means break even point is no loss, no profit zone. And where company earns no profit, no loss, and it can be expressed in units or rupees. You can tell break even point in units as well as in rupees, like in rupees and volume. Break even point, what is the formula for break even point in units? Fixed cost divided by contribution per unit. Fixed cost divided by contribution per unit. Now the same example we are going to calculate break even point as well. The same example we are calculating break even point. Now if you see, what is the contribution per unit? 4 rupees. That means by selling one unit, you are earning a contribution of how much? 4 rupees. You are earning a nothing but profit. You are earning a profit of how much? 4 rupees. Now this profit is utilized to pay which one? Fixed cost. First you have to pay fixed cost. In from each unit you are getting how much? 4 rupees. Now what is our fixed cost? 500. For paying 500 rupees, how many units you need to sell? From each unit you are getting 4 rupees. You have to pay how much amount? 500 rupees as a fixed cost. Now how many units you need to sell to pay this 500 rupees? 500 divided by 4 rupees. From each unit you are getting 4 rupees. That is nothing but 125. Now what is your break even point? If you sell 125 units, you will get 500. You will pay fixed cost. Now you left with the big zero. That means you don't have any profit, any loss. That is our BEP na. Now our BEP point formula is total fixed cost 500 divided by 4 rupees. What is 4 rupees? Contribution per unit. That's what I wrote here. I explained through formula as well as I explained through in logical manner as well. Next, BEP in rupees. BEP in rupees. What is the formula? Total fixed cost divided by PV ratio. In the place of contribution per unit, you are taking PV ratio. You will get break even point in rupees. For example, here. What is the fixed cost? 500. And what is the PV ratio? 40%. 500 into 40%. Oh, sorry. 500 divided by 40%. 1000. That means if you sell goods for 1250, then you will reach the destination no profit, no zone. No profit, no loss zone. If you sell goods worth of 1250 rupees, then you will reach the point no profit, no loss zone. That is nothing but break even point. So what is the formula for calculating the break even point in rupees? Fixed cost divided by PV ratio. Next, there is another formula for BEP. BEP in units into selling price per unit. It will give us break even point in rupees. Break even point units into selling price. 125 into 10. That's what we got in rupees na. Break even units into selling price per unit. You will get break even point in rupees. It means if you want to recover something, the formula is always cost divided by contribution per unit. If you want to recover any cost, all we need to do is cost divided by whatever cost we want to recover divided by contribution per unit. Then you will recover the cost in units. Or if you want it in rupees, then it is nothing but cost divided by PV ratio. It will give us in units. If you want in rupees or like in sales, the formula is cost divided by PV ratio. You will get the rupees value. How much amount of sales you need to do to recover the particular cost. For example, I want to recover a cost of 20,000. Over and above fixed cost, I incurred some extra cost. Over and above fixed cost, I incurred some extra cost, research and development cost. What cost? Research and development cost. Now I want to recover this research and development cost. Now my fixed cost is 10,000. What is my fixed cost? 10,000. Over and above, I incurred 20,000 for what? Research and development. Now, what is the total cost I incurred as a additional cost 10,000 plus 20,000, total I need to recover 30,000 from sales only. Now 30,000 divided by what is our contribution? 4 rupees. Take it as 4 rupees. 30,000 divided by 4, 7,500 units. That means I need to sell how many units? 7,500. For example, I want it in sales rupees. 30,000 divided by PV ratio, how much? 40%. 30,000 divided by PV ratio, that is 40%. How much? 75,000. If I sell 75,000 rupees of sales, then I will get a break even. I will reach break even level, or nothing but I will recover my all fixed cost as well as research and development expenses. Sometimes question may ask us to recover fixed cost plus profit. Sometimes the question, they ask the question like, company want a profit of 20,000. Now how many units of goods it must sold to get a profit of 20,000? What happened? Bluetooth pairing device request. Where is the TV remote? When I am taking classes in Vijayawada, one of the institute, the TV, those guys are using the TV for watching the some short videos or YouTube videos. They connected their mobile through Wi-Fi. While I am teaching in the class, not in our class guys, the guys from other class, they connected YouTube. They are seeing the interview of Vijay Mallya. Recently one podcast happened, not recently, 1 year or 2 years back. They are watching this that podcast. I am cancelling it. They are taking 2 minutes of time. Again they are connecting. That's why I am asking, is someone intentionally connecting? No, na? Sure. Next. Sometimes question may ask us to calculate. Sometimes question may ask us to recover fixed cost plus profit. Like they ask question like, what amount of sales we require to get a profit of 20,000? To get a profit of 20,000, first you need to recover variable cost. After variable cost, you will get contribution. The contribution is utilized to pay fixed cost. The whatever amount left is profit. Now let's take an example of fixed cost is 15,000. After recovering 15,000, you want 20,000 as a profit. That means total contribution we required is how much? 35,000. Now total contribution we required is 35,000 divided by what is the contribution per unit? Let take it as 10 rupees. 35,000 divided by 10, 3,500 units. If you sell 3,500 units, then you will get a profit of 20,000. To get in units, fixed cost plus profit divided by contribution per unit. If you want in rupees, the formula is fixed cost plus profit divided by PV ratio. Cash BEP. What is it? Cash BEP. That means only what is the fixed cost. In fixed cost, sometimes in fixed cost, depreciation is also included. In fixed cost, what is included? Depreciation. Now, depreciation is a cash item. No, it is a non-cash expense. Fixed cost is nothing but a non-cash expense. We already incurred in past. The benefit we are deriving today, that's why we are segregating the amount, that capital expense, to all years. That's it. Fixed cost is not incurring today. That depreciation amount is not incurring today. We already incurred in while purchasing the asset as a capital expenditure. Now we are turning that capital expenditure into revenue expenditure over the period of or over the lifespan of the asset. Like I purchased one laptop paying 1 lakh rupees, Apple MacBook. The lifespan of the MacBook is 5 years. Now I already incurred the capital expenditure of how much? 1 lakh on the purchasing year only. Now I am using this laptop not for 1 year, I am using for 5 years. That's why I am giving this cost benefit to who? To 5 years. Now I am turning my capital expenditure of how much? 1 lakh into revenue expenditure over the period of 5 years. That's it. Next, cash BEP. How to get cash BEP? Cash fixed cost divided by contribution per unit. What is cash BEP? Cash fixed cost divided by contribution per unit. Nothing but total fixed cost minus depreciation or non-cash items. Total fixed cost minus depreciation minus non-cash items. You will get contribution divided by contribution per unit. You will get cash BEP. Now I will explain this break-even point with a graphical presentation. What is selling price? 20 rupees. What is variable cost? 12 rupees. What is fixed cost? 300. This is which axis? X or Y axis? This is Y axis. Now 100, 200, 300, 400, 500, 600, 700, 800, 900, 1000. What is our fixed cost? Our fixed cost is 300 only, na? Am I correct? Fixed cost is 300. Now, next 10, 20, 30, 40, 50, 60, 70, 80, 90. On Y axis we are taking as cost and revenue. On Y axis we are taking it as cost and revenue. On X axis we are taking it as units. Now fixed cost is constant. If you produce 0 units, your fixed cost is 300. If you produce 10 units, your fixed cost is 300 only. If you produce 100 units also, your fixed cost will be 300 only. Now variable cost. Variable cost line starts from where? From where variable cost line will start? Tell me. From origin, or from 300, or from 100, or from 600? From where it will start? From origin only. If you are not producing anything, your variable cost will be 0 only, na? If you are producing 0 units, 0 into variable cost 0 only. If you are producing 1 unit, your variable cost will be 1 into variable cost. Now what is our variable cost? 12 rupees. 12 into 1. Now you are producing how many units here? 10. In total how much? 100 units. For example, it is 100. It will start from origin. The variable cost line will be straight line. Variable cost line is a straight line only. Now for 100 units, 100 into 12, that is 1200, na? That means where is 1200? I think here. Now For 0 unit is 0. For 10 units it is 120. For 20 units it is 240. For 30 units it is how much? Like 360. Like this. It will increase in parallel basis in the same ratio. Now tell me what is the difference between variable cost, fixed cost, semi variable cost. Then what is the difference between variable and semi variable? Variable cost increases along with the output in the same ratio, in the same proportion. Variable cost will increase along with the number of units or output or volume in the same ratio or in the same proportion. For example, for 10 units it is 100. For 20 units it must be 200. If it is 200, then it is variable cost. Here for 100 units it is 100, 10 units it is 100, for 20 units it is 200. It is increasing in the same ratio. For 300 units it is 300. For 30 units. For 40 units it is 400. If it is increasing like this, this is variable cost only. Now, for 10 units it is 100. For 20 units also it is 100 only. Then it is fixed cost. Fixed cost won't change due to output. For 10 units it is 100. For 20 units also it is 100. For 1000 units also it is 100 only. Now, for 10 units it is 100. For 20 units it is 250. Sorry, 150. Semi-variable cost will increase along with the number of units or output, but not in same proportion. If it is in same proportion, if it is increasing in the same proportion, then it is variable cost. If it is not increasing in the same proportion, then it is semi-variable cost. Semi-variable cost will increase, but not in the same proportion. If it is increasing in same proportion, then line must be straight line. Then line must be a straight line. Now, this is total variable cost line. This is total fixed cost line. Then where is what we need? Another. What we need another? Tell me. Sales, total sales. Now tell me, sorry, total sales line, and as well as we need total cost line. Now tell me, total cost will start from where? Total cost line will start from where? Total cost means variable cost plus fixed cost. If you produce 0 units, your total cost will be? Yes. If you are not producing anything, your production is 0, then your total cost is equals to your fixed cost. That means at 0 units, your total cost is equals to 300. That means your total cost will start from 300 and goes along with parallel to the total variable cost line. From here it will start and it is parallel line with whom? Total variable cost. It is total cost. Now, why? Because your total cost is always greater than your variable cost. It is always parallel to your total variable cost. The difference between total cost and total variable cost is always fixed cost only. It will be constant. It will be same. Next. Now tell me what we need. Another line. Total sales line. From where total sales line will start? From origin. If you are not selling anything, If your sales is 0, if your sales is 0, then your total revenue will also 0 only. Now total sales line is starting from origin. Now what is the sales amount? How much it is? Per unit it is 20. That means for 50 units it will become 1000. Where is 1000? Here only, na? That means the total sales line must pass through origin to 1000. Now this is total sales or revenue, total revenue, TR. I think you got this same diagram in your economics, in foundation, in your +2. Now this is the point where these two lines are intersecting. Which two lines? Total revenue line and total cost line. The point where these two lines, total revenue line and total cost line, are intersecting, that point is known as break even point. This point is known as break even point. This is called break even point, and this is known as, what is it? Angle of incidence. You guys don't know angle of incidence also? Then how you survived in economics, Ray? This gap is known as the difference between, after reaching the break even point, whatever the gap we have between TR and TC, this gap is known as angle of incidence. If your angle of incidence is narrow, it will that means you are getting lot of time to reach the break even point. Your angle of incidence is narrow, that means you are taking lot of time, or it is taking lot of units to reach the break even point. If your angle of incidence is wide, that means your break even point is very low. If your angle of incidence is wide, your break even point is low. Your angle of incidence is narrow, your break even point is very high. Now tell me, what will happen to break even point if sales increases? Sales units. If sales units increases, break even point will change. It will the break even point will go high, or break even point will go low. If number of units increases, sales, there is no change in the break even point. It will stay constant. Why? Because there is no change in the cost, prices. Break even point only change when prices change. Whenever prices are changing, then only break even point will change. If something happened to units, if units increases or units decreases, sales increases, sales decreases, in terms of units, the break even point doesn't change. Keep in mind, only break even point will change only when cost changes. If cost increases, break even point also increases. If cost decreases, break even point will also decreases. If selling price increases, decreases. Why? Because if selling price increase, there is no change in the now this is selling price. Now this is selling price, this is variable cost. Now if selling price increases, the gap between selling price and variable cost is increasing. Nothing but contribution is increasing. If contribution increases, break even point decreases. If contribution increases, break even point decreases. If cost, for example, this is selling price and this is variable cost. If variable cost increases, the gap between selling price and variable cost is decreasing. That means your contribution is also decreasing. If contribution decreases, your break even point will increase. If fixed cost increases, break even point will also increases. If fixed cost decreases, your break even point will also decreases. I hope you understand the logic behind break even point. Any doubts regarding break even point? Any doubts? Next one is, what is it? Margin of safety. Till now we recovered which one, Nana? Fixed cost. From contribution till now we already recovered the variable cost. That is not our headache at all. From contribution we already recovered what? Fixed cost. Now it's time to recover profit. Now it's time to recover. Fixed cost will tell us about break even point. Now profit will tell us about margin of safety. We use fixed cost to know about break even point. We use profit to know about margin of safety. It is excess of actual sales over BEP sales. What is margin of safety? Whatever amount of sales we sold, whatever amount of sales, whatever amount of output we sold over and above BEP, that entire part comes under margin of safety. That means my sales is 10,000. My total sales is 10,000. My break even point is 5,000. Now my margin of safety is 5,000. For example, my break even sales is 9,000. What is my margin of safety? 1,000. So whatever amount left over and above BEP sales, that is margin of safety. Whatever amount of units left after BEP units, then that is known as margin of safety. It is the excess of actual sales over BEP sales. Since we already recovered our full cost, in break even point, so now it's time to earn profit. We already recovered which one, Nana? Break even sales. Now it's time to earn some profit. Without profit, no business will survive, na? So that means without margin of safety, no business will survive in the market. Now what is the formula for MOS? For break even point we use fixed cost. For MOS we use profit. Same formula. In the place of fixed cost, we will replace with profit. Now margin of safety in units is equals to profit divided by contribution per unit. Next, margin of safety in rupees is equals to profit divided by PV ratio. If you want in rupees, use PV ratio. If you want in units, use contribution per unit. For anything, if you want in units, use contribution per unit. If you want in rupees, use PV ratio. So another formula for getting margin of safety: sales minus BEP sales, sales units minus BEP units. You will get margin of safety. Now, what is the relationship between margin of safety and BEP sales? Same like variable cost and contribution. Total sales is equals to BEP sales plus margin of safety sales. That is 1 is equals to BEP percentage plus margin of safety percentage. If something, for example, in the question they said margin of safety sales is 60%, then what is the portion of BEP sales? 40%. In the question they said BEP sales is 50%. What is the portion of margin of safety sales? 50%. So the relationship between margin of safety sales plus BEP sales, you will get a total sales. There may be a situation when company produces more than one product. Sometimes company may produce more than one product, nothing but multiple products. We need to calculate weighted average contribution. Whenever company is producing more than one product, then we need to calculate weighted average contribution. How to calculate weighted average contribution? Number of units of A into contribution per unit of A. Contribution of A into number of units of A plus contribution of B into number of units of B divided by total number of units. How to get weighted average? Same formula for calculating all weights. We use this type of formula only. Number of units of A into contribution of A. Number of units of B into contribution of B divided by total number of units. Total number of units means units of A plus units of B. You don't have any problems in institute material regarding BEP with multiple products. If company is producing one product, it is very easy to calculate BEP. Why? Because we know fixed cost, we know contribution per unit. Whenever company is producing two or more products, if company is producing two or more products, how you will calculate BEP? For A product, there may be a separate contribution. For B product, there may be a separate contribution. Then which contribution you will take? How you will get? How you will weight it? That is used to calculate weighted average contribution. That's it. Here the scenario is something different. To calculate multiple BEP, we need sales mix ratio. We need which ratio? Sales mix. That means in the market, how many units of A and how many units of B is selling? In which ratio you are selling? Like we are selling two products, A and B. I am selling in the ratio of 5:2. That means if I sell 5 units of A, then I will sell 2 units of B. That is the ratio. That is very important for calculating the multiple BEP. What is multiple BEP? Whenever we have two or more products. Whenever we have two or more products in the product range, then we use multiple break-even point for calculating this multiple break-even point. For that we need contribution, total fixed cost as well as total sales mix ratio. Now, what is the formula for calculating multiple break-even point? Total fixed cost divided by contribution not per unit, per batch. Contribution per batch. Read example. Read example. We have two products. Products are X and Y. Selling price of X is 500. Selling price of Y is 25. Variable cost 30, 15. Then what is the contribution? 20 and 10. Fixed cost is how much? Fixed cost is how much? 1,50,000. Now what is the sales mix? 3:2. That means in the market we are selling 3 units of A and 2 units of B. Now I am taking this as a batch. Now I am considering this sales mix as a batch. Now I am selling in the market one batch. In one batch consists of 3 units of A and 2 units of B. Now if I sell 3 units of A and 2 units of B, I will get like X and Y. What is the contribution? 20 and 10. Now what is the sales mix? Three is to 2. Then in batch, now I am taking this 3:2. That means 3 units of A and 2 units of B as one batch. Now if I sell 3 units in a batch, if I sell 3 units of A, I will get a contribution of how much? 60 plus in the same batch I have 2 units of Y. 10 into 2, that is 20. That means how much I will get? 80. By selling one batch, I am getting a contribution of how much? 80 rupees. Now, for one batch, I am getting 80 rupees. Now, how much amount I have to recover? 1,50,000. Now, by selling one batch, I am getting 80 rupees. Now, I want to recover how much? 1,50,000. Now, MBEP is equals to, what is the fixed cost? 1,50,000 divided by 80. 1875 batches, not products. 1875 batches. In one batch consists of how many units of A or X? 3 units. How many units of Y? That is 2 units. Am I right? Now 1875 into 3, how much? X is equals to 5,625. Y consists of how many? 3,000. 3,007. That's it. Now we will calculate this in mathematics form as well. Now we know at break even point our total cost is equals to, contribution is equals to fixed cost. We all know that at break even point our fixed cost is equals to what? Contribution. Now fixed cost is how much? 1,50,000. Am I correct? Now how you will get total contribution? Contribution of A plus contribution of B. Correct na? Now we know that contribution per unit. How you will get total contribution of A? Number of units of A into contribution per unit. How you will get? Number of units of A into contribution of A plus number of units of B into contribution of B. That is equals to how much? 1,50,000. We all know contribution of A and B. We don't know number of units. Let's take number of units as X. We are taking number of units as X. Now, what is the contribution of A? How much contribution of A? 20. Contribution of A is 20. Correct. 20 into X, that is 20X, plus what is the contribution of B? 10. 10X is equals to 10. I am taking this as number of units as X only for both. How much it is? We are getting somewhere we did a mistake, right? Total contribution. Sorry. Here divided by 3. Here divided by 2. Why? Because our ratio is 3:2. Out of total units, our total unit, this is into. Out of total units, we are sharing it in 3:2 ratio. Now, number of units is X. So 20 into, that is X, that is 20X into 3. How many ratios? 3 ratios, plus 10X into 2. That is equals to 1,50,000. Now 80X is equals to 1,50,000. X is equals to 1875. Now this is batches. Now this is 1875 into 1875. Now this is 1875 into 1875. Now this is batches. 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 Now this or if you divide it with 3, you will get in directly in units. Now 20x divided by 3, what? I'm not good. Here we have 1875 batches into 3 into 2, you will get the number of units of A must sell, number of units of X and Y must sell to get a break even point of or nothing but 1,50,000 to reach a level of 1,50,000 or recover the fixed cost of 1,50,000. Now 1875, now see 1875 into 3 into 2, how much? 5,625 and it is 3,750. That's it now. Into what is the contribution? Into 20. Here it is into 10. Calculate the amount. 1,12,500, 37,500. If you add these two, you will get total amount of 1,50,000 and the total sales is in the same ratio, that is 3:2 ratio. Here sales mix is given for units, not for in rupees. Here we are taking that sales mix is for which one? Units. That means A how many units? 3 units of A. B how many units? 2 units of B. Here sales mix is for which one? Units, not for rupees. If you see, this 2 is in same ratio, that is 3:2 ratio. So what is the formula for calculating break even point in which one? Multiple break even. What is the formula? Fixed cost divided by contribution per batch. Okay. We will do this problem after lunch break. Take lunch break.